Oi!
My name is Scott Davis. I run a company called Melius Research, which is a boutique research investment house that was founded about 18 months ago. A bunch of ex-Morgan Stanley and Barclays senior folks, and we focus on industrials and data analytics. We focus on industrials research, and industrials, when you really think about it, it is the oldest sector in the S&P 500. It is battle-tested. It's been around for over 100 years. GE was the original industrial, if you want to call it that, and actually was thought of as really a tech company back when it was founded back in the late 1800s. We focus on industrials research because it's central to almost every major economy in the world, particularly when you go into emerging markets where industrial economies tend to equate to extraordinarily large amounts of GDP, say 2 or 3 times that is important as the US. We follow a lot of macro data. We look at an awful lot of just reams of data, most of which is macro, some of it is micro, some of it's proprietary, really to glean, have a view at least about the economy overall, and then what sectors make the most sense to invest in any particular time. And of course, as I said, our expertise is in fact in industrials. Generally, we're bullish on the industrial cycle. And the cycle overall, the business cycle. What we see really playing out in the next several years is a return to investment in developed markets. So when you really think about the last 20 years, every incremental dollar of capital has been spent predominantly in emerging markets. We see that reversing. Now, more money coming back to, in particular, the US, to a lesser extent maybe Europe, but really the US is the place that we're most bullish on. And then the countries around the US like Canada and Mexico are certainly beneficiaries as well. When we think about that incremental dollar of capital spent in the US, the best illustration I'll give you of why this is important is that when US companies sell into a country like China, they're typically selling into a region with a ton of competition. You're competing against the Japanese, the Koreans, the Europeans. On average, you might capture maybe 15% market share. When you sell into the US market on your home turf, your market share may be as high as 30 to 50%. So every dollar of capital that comes back from being spent in an emerging market to a country like the US has really a multiplier effect on the companies that we follow. And when I talk about companies we follow, it could be everything from 3M to Emerson to Honeywell. Even we cover aerospace, so companies like Boeing, for example, which obviously has some challenges right now, but longer term, big picture is fairly bullish overall. So that's the way we look at it. As far as what inning we are in the cycle, we think we're probably in the general business cycle, we're probably in the 7th inning. In the industrial business cycle, we think we're probably more like the 4th inning. So I wouldn't call it early cycle, but probably more like mid-cycle. And we think we've got several really good years in front of us on the industrial side. What we learned in 1Q is that the business cycle, the things that we just referenced as far as being bullish longer term, are actually playing out. Investment is being made in the US, and that investment could be as simple as supply chain, things like warehousing and stuff like that, to actual factories, to automation, to robotics. We're seeing that spend. What we are seeing on the other side of it is a real slowdown in emerging markets, in particular China, and in particular the Chinese consumer. So when you think about the Chinese consumer who has been just buying car after car for the last several years, auto sales have been through the roof. Auto sales, for example, right now we're seeing is really, really weak. So our investment case as far as money coming back into the US is playing out in real time. We're seeing that for sure. We saw that in the results. The companies that were more levered to the Chinese consumer were the companies that really struggled this quarter the most. So like 3M is our most global company, and it's about 35% emerging markets, and really struggled this quarter because those markets in particular are weaker. The companies that are more focused on the US and more focused on what we call later cycle things, which are more project and capital spending type activities, companies like Honeywell. Those are the companies that gave us just fantastic results in the quarter, and we think that's going to continue really for at least the next year, maybe up to 3 years. The other thing we get excited about in industrials are megatrends. And when I think about megatrends that influence industrials the most, it would be things like electrification. So you think about electric vehicles, which in itself is amazingly exciting. But even further than that, it's just the electrification of the world. You go from a world that is burning a lot of coal to solar and wind and other more environmentally friendly technologies. Each of those technologies benefit the industrial world, if nothing else, because you need to spend money around them. You need to spend money to fix the electrical grid if you're going to put solar and wind on. You need to build new factories if you're going to build electric vehicles. I mean, just look what Tesla has done out in California, and look at some of the electric vehicle launches that we're seeing even from like General Motors and Ford. They require new plant and equipment. They require new robots and I'll just call it new capital, period. And that investment benefits us tremendously. The other thing that excites us is infrastructure. And I don't think it's going to come as any surprise to anyone when you look across the US and just see how old our infrastructure is. And I don't care whether you're talking about our highways or rail or airports, whatever. I mean, we haven't built a new airport. And gosh, I think it's like 45 years or something. The last new airport that was built in this country, big airport at least, was in Denver. All of that stuff needs a huge investment. And so when out of Washington they talk about a $2 trillion infrastructure plan, I think that eventually you'll see money being spent out of the federal government. But we almost don't need it because the private sector itself will start to invest heavily in the infrastructure because it just has no choice. That is also just extraordinarily bullish long term for industrials. The other thing we're excited about is global air travel. And when you think about the population in emerging markets, of which so many people are getting on an airplane for the very first time, and rather than taking an 8-hour boat ride between different islands in Indonesia, for example, or the Philippines, jumping on an airplane for a 30, 45-minute jaunt is just so much more practical. And I think once you do that, you're unlikely to go back to the methods of transportation that you engaged in before. So when we think about global air travel, that's an exciting theme as well, which will also require spending. It'll require spending on new airplanes, and we've seen really strong orders for Boeing and Airbus, really the only two aircraft manufacturers in the world. And we'll need new airports. And when you talk about new airports, airports need a lot of electrical wiring and lighting and air conditioning and security systems and all kinds of stuff that our companies sell. So that's another theme that I think we're really excited about. When we think about industrial companies, we think globally. It's tough to have a conversation about Boeing without talking about Airbus. It's tough to have a conversation about Caterpillar without talking about Komatsu. It's tough to talk about Emerson without Yokogawa, which is a Japanese process automation player that competes against Emerson. It's a global industry. When you look at the US players and the European players, their footprints are pretty similar. And normally what we see in a global industrial, the average global industrial, let's just say a Honeywell, for example, would be revenues of about 50% in the US, call it 25% in Europe and 25% in emerging markets. Some sort of a mix roughly about that ballpark. So it's not good enough just for the US to be strong for our average industrial company to do well. I mean, the world needs to be relatively healthy. I mean, you can't be in a recession and in the rest of the world and still be okay in the US for more than maybe a couple quarters, which I think we've seen some of that lately where the rest of the world's slow while the US is strong. We would expect the rest of the world to perk up, and we've seen signs of that already. But it really is a global industry. Folks compete globally. It is largely consolidated because industrials, and talking about an industry that goes back 100 years, you have major conglomerates, big, successful, great companies like Siemens in Germany, for example, or Schneider in France, and competing against companies like GE in the US and Mitsubishi in Japan. These companies have had literally 100 years to consolidate their competitors and their supply chains and things like that. And so generally industrials are much more consolidated than most other sectors out there, just primarily because it's just been around a long, long, long time. One of the things that we're really excited about is technology moving down to the factory floor. And I think most people are comfortable or at least aware of what a robot is. But robotics technology has come a really long ways. And I'll just give you an example. A traditional robot was something that was put in a cell somewhere. It had to be far away from people because it could whack you in the head or generally could be dangerous if it was moving and somebody didn't pay attention. Now they have things called cobots, which are basically robots that will stand right next to you on the factory floor and help you. So maybe instead of bending over and having to pick up something and put a part together, let's just say on an auto plant, you could stand next to that robot and the robot could really do the heavy lifting and all the difficult stuff for you, and maybe the person just make sure that it's done right and positioning and such. So that change is massive, because when you look back 20 years ago, jobs went to places like China purely because of labor costs. And when folks put factories into China, they did not automate them, or they automated them just a little bit. When you think about bringing jobs back to the US and factories back into the US, you need to do so in a reasonable cost basis. And how we think about it is if you can take 50% of the jobs out of a traditional factory and put it in the US, you're pretty much at cost parity with that same factory in China. The only way to take those jobs out, though, are with robots and general automation. And so we think, companies like Rockwell Automation, for example, which is one of the leaders in automation, are really exciting for us, because these factories just have to change. They need to become more productive, more efficient. Quality control needs to be higher. And they need to move closer to the supply chain, which means closer to the customer. And if that customer is in the US, then you're more likely to build that product in the US going forward versus building it somewhere else and then shipping it all the way across the world. So I think those developments are exciting. It's still early days, but the technology is moving really rapidly from what we'd characterize as the consumer electronics boom that we've seen in the last 10 years or so to something similar we think is going to happen on the factory floor, particularly around connectivity and IoT, that could just completely change the way that companies make products going forward. It's actually a great question around, what are the competitive threats as automation proliferates. And what we've learned, at least, is, and gosh, I've toured hundreds of factories in my life, and what we've learned is that domain knowledge is still critical. So it's really hard. People come to us and say, okay, we don't understand why Microsoft or Oracle hasn't come down to the factory floor more aggressively and taken market share from some of the traditional automation guys. And the reality is that each individual customer type has its own processes and their own nuances. So pharmaceutical, for example, has its own needs versus the auto industry versus consumer electronics. Like you're making an iPhone, for example, is going to be way different than making a biologic like Humira. That domain knowledge becomes really critical, and that's the main barrier to entry from the tech industry coming in aggressively into the industrial world. What needs to happen, though, and what we think will happen, are more partnerships. So, for example, we do see situations where, like Rockwell Automation has a tremendous partnership with Microsoft because there's technologies they both can bring to the factory floor together that are more powerful than going separately. When we think about picking stocks, we start thematically. What are we excited about? We talked earlier about being excited about capital spending, automation, electrification, some of these mega trends. Then you bring it down to the individual stock level, it gets a little bit muddier and a little bit more difficult. We are super excited about Rockwell Automation because it's a pure play automation company in the factory floor, just exceptional company. We're excited about Emerson. Emerson is about 2/3 to 3/4 automation now. It's almost a pure play. It has some other businesses, but huge automation business. Honeywell plays to these themes, not just automation, but also other capital spending themes, and has a large aerospace business that we're bullish on. Those are three names that come to mind on the automation side. When we think about electrification, T Connectivity, maybe a company that not a lot of folks have talked about. It's not a household brand, but T Connectivity is a company that makes all the connectors and little electrical widgets that go in an electric vehicle. And that's exciting to us as well. So there's several names to play. Everything I think we're recommending stock-wise plays into a capital spending theme in some way, shape, or form. When I think about my colleagues at Melius, some of the stocks that they're excited about, Carter Copeland, who does aerospace for us, loves Boeing. He loves buying Boeing on this pullback that we've had here because he believes in the dynamics around global air travel and the demand for new airplanes over the next long term, more than 5 years, 10 years, as folks travel more. My other colleague, Rob Wertheimer, is super excited about the technology advancements being made at companies like Trimble, for example, and the value that you get in buying a Caterpillar, because when you think about infrastructure spend, you really can't do that without moving dirt. And Caterpillar is the best dirt mover in the world. So those are a few stocks we're excited about. There's others smaller down in market cap that you can play that maybe provide some more upside. Things like Rexnord, that company probably not a lot of folks have heard about. ITT, which is another one that's relatively small but exciting as well. So when we think about the stocks we don't like, it's really just the inversion of what we're recommending, which is if we love capital spending, that largely means we don't love stuff that's going to be kind of shorter cycle, more flow goods. That the poster child of that would be a 3M, and 3M is struggling right now. It is a world-class company. It's a fantastic company, but we just don't see demand for their products right now. That'll change in a couple years, as things cycle in and out. They're also more exposed to emerging markets than other companies that we cover. And again, we would prefer to have more U.S.-based exposure in as much as you can get it. I mean, most of our companies are global, of course, but less global. Generally, I think anything that is kind of shorter cycle, more flow goods, we're going to be less bullish on. We're not outright bearish, I would say, on anything, just because the industrial economy is still in its relative infancy, compared to the consumer economy. I mean, we're just now a couple years. I think we're 7 quarters into an industrial upcycle. That's really not much at all compared to the general business cycle, which is now a solid 8-9 years in the making. When we think about the global macro picture, and first of all, just the elephant in the room is just debt. There is a tremendous amount of sovereign debt out there. It doesn't matter what country you look at. The countries have just been piling debt upon debt upon debt. That's the biggest systemic risk that we have right now overall, and we do lose some sleep over that, because it does call into question our view that infrastructure spend has to happen, yet we have a lot of government debt. So how do you fund it, et cetera? Do you do it with the private sector? Is it public-private partnerships? We'll see as we get there. What we do know is that the money needs to be spent. We think it will be spent. How you pay for it is going to be a little bit more challenging, but I think we'll probably just end up accumulating more deficits to get to that point. When you just look around the world, the U.S. right now is the biggest beneficiary of everything that's going on out there. Some of it is because of the tax bill. The tax bill is relatively unpopular. We all know that. However, the tax money that our companies are saving, we're now starting to see transition from largely going into buybacks to actually going into capital spending. So we're actually seeing a fairly large investment cycle playing out with that tax savings. That's going to help a lot. Some of that will be internal investment like R&D. Some of that will be actual capital investment. Some of that will be infrastructure type investment. We'll learn more over the next couple of years as that money's being spent. But overall, the U.S. is the biggest beneficiary of that. When you look at the rest of the world, it's hard not to be bullish on Mexico, just given the proximity to the U.S., what's going on in the U.S., and the fact that Mexico still provides relatively cheap labor and lots of product can be made there and easily shipped up into the U.S. Canada, to a lesser extent, doesn't offer cheap labor, of course, but Canada as a trading partner is critical to the U.S. So North America overall looks solid. Europe is a little squishy. I think on the capital spending side, it's okay. On the consumer side, it's weak. Auto sales are stumbling here. I think consumer confidence is relatively low, but we think we've hit a bottom there. China is a tough one. China, we are long-term bullish on, just because I think the country itself is in relatively decent shape from a competitive dynamic. I mean, lots of good startup and emerging Chinese technology companies that are interesting that I think are going to help drive that economy for years to come. I think the consumer is now completely addicted to being a modern-day consumer. So what we've grown accustomed to in the U.S., I think the Chinese consumer is rapidly adopting. So I think China will be fine, but we're going through a rough stage there right now, and I think that'll come out probably in the back half of the year. Other countries around the world, Venezuela is a mess. I'd like to be able to say that we get stability there at some point. I'm not sure you ever will. Brazil, the same. I mean, it's always the great hope that Brazil is going to be this fantastic emerging nation in the world, and just always seems to falter. India is another important region for us, and I think India looks really, really solid. And most of the rest of the world doesn't really move the needle for us anymore. Russia, for example, the Russian economy is just too small globally to make much of a difference. But generally, we think emerging markets are coming up and bottoming out and will come up in the back half of the year. Europe is stumbling right now, and I think Europe also will show some improvement in the back half of the year. The U.S. is the lone growth engine of the world. It's really North America, not just the U.S., and we think that'll continue. The tricky part is that if we're wrong and emerging markets don't turn up, then the U.S. can't be the lone growth engine in the world forever. It can certainly do that for a couple quarters, but not forever. So that's the risk. We think those risks are worth taking, though. Business cycles end largely because somebody does something stupid, and that somebody could be the Fed. They could over-tighten, and I think the risk of that at this point is relatively low. I think the Fed was late, certainly very late, and seems to be in a permanent pause, or at least a pause right now that's relatively constructive for our themes. We mentioned government debt earlier, and we're still concerned about the levels of government debt out there, but when you balance that against debt levels on the average company out there aren't that high, and the debt levels at the consumer level aren't that high. So government debt is high, but the rest of the system seems to be relatively healthy. We lose sleep over things that we can't control, and those things you can't control are the 9/11s of the world, the bubble bursting, the housing bubble that burst in 2008, and the Lehman bankruptcy. Those were catalysts that drove the economy down. And what typically happens is that event, whatever that event is, causes a collapse in confidence. And as soon as you have any real hit to confidence, then all of a sudden these projects that we're talking about get delayed and potentially canceled. So if you look back at 2008, for example, the best call that we made in my career, we downgraded industrials to a sell in April of 2008, and we were several months ahead of really the general macro. And the reason for that is that we were tracking a World Bank database that showed that projects went from green light to yellow light on its way to red light really fast. So we had tracked about 40 big global projects that were well financed and seemed to be progressing quite nicely, that all of a sudden hit delay. They were delayed either because of financing risk or just general confidence. To bring that back home, for example, one of those big projects was in Las Vegas. It was the City Center, I believe it's called. Huge multi-billion-dollar spend that was going on in Vegas in early 2008. By mid-2008, that project was being shrink-wrapped. Literally, they stopped construction and they put tieback wrap, DuPont tieback wrap around the thing and just completely sent all the workers home and just shelved it. It's stuff like that that causes a virtual collapse in the system. So anything that would really impact confidence is something to watch for. Could it be the presidential election next year and an outcome that business leaders don't like? Sure. Politics normally don't play into it as much. It's normally some other black swan event just because it's something that's really hard to predict. Gosh, if we could predict those things, we'd have a different career, I think. It would be quite amazing, and you just can't. What you have to do, though, is position yourself so that if those events happen, you're going to get completely blown up. So we generally tend to favor, the higher quality companies that we cover that address the themes that we want to address, but perhaps address them in a less dynamic fashion, meaning just less risky fashion. One of the pushbacks we get in industrials is, aren't we late in the business cycle? And when we think about the business cycle versus the industrial cycle, we think of them as completely two different buckets. Industrials overall represent about 10% of the S&P 500, represents about 10% of GDP. If you go back and look at the industrialization of America after World War II, those were multipliers of that. I mean, industrial economy mattered a lot more. We think the industrial economy can actually do very well, even if the other economy, if you will, the consumer economy and everything else related to that slows down, largely because what you might see, or what we think you'd see in a macro slowdown, is a government come in and spend money on things like infrastructure, and that directly benefits us. So over the last 20 years, we've seen increasingly dislocation between the industrial and consumer economies and the general economy overall, and I think that's gotten a little bit lost in translation of why and how sustainable that is. And our view is, at least, that the industrial cycle, being much later and having far different drivers and dynamics and secular trends and mega trends like electrification that I mentioned, the industrial economy may actually do very, very well, even in a mild recession overall. There's a couple things to remember, I think, with industrials. One is that you want to buy them on pullbacks. You generally want to buy weakness. A company has a bad quarter, for example. You normally want to be, and you still like the themes, you normally want to be a buyer of that, not a seller. It can be an emotional group where stocks swing. For example, 3M dropped 13% this quarter on its earnings day and has had a tough year, but generally you want to be buying those types of dips. Even though 3M isn't one of our preferred names right now, it is an industrial name that's pulled back a lot. Overall, I would say that we are really excited about these mega trends. Again, whether it's environmental, whether it's electrification of the world, whether it's infrastructure or robotics, really bringing jobs and factories back and the supply chain back to places like the U.S. that can become competitive from a manufacturing perspective again. These are all longer-term trends that I think are going to take at least a decade to play out. There's going to be cycles. There's going to be times when these stocks are out of favor and in favor. Generally, what we'd say is you want to buy them when they're out of favor. We saw that in December and January, for example. The stocks started to come back in January, and we had a pretty good start of 2019 overall. I think industrials is the second best performing sector in the S&P year to date, and we would expect that performance to continue.